Well, thanks everybody. This is Jason Fritz speaking, and we are really excited to present to you today on transfer pricing after US tax reform, which it's hard to believe, but it actually was enacted 2 years ago. Those 2 years have flown by. So, just a little bit about me. Speaking of flying by, I can't believe I've actually been practicing transfer pricing for it'll be 16 years about 1 month from now. So, been doing a fair amount of transfer pricing over the last 16 years in regards to planning and documentation and helping clients with any controversy that they might have. And joining me today is Kylie Green. Kylie, can you please give us some of your background?
Yeah, hi, my name's Kylie Green. I've been working in transfer pricing for just over 3.5 years, and I've been with Bailey for almost a year and a half.
Awesome. Well, let's look at what we're going to talk about today, Kylie. So I always like to do a little bit of a refresh on transfer pricing whenever we talk or do any presentations, just to level set, make sure we're all on the same page about what we're talking about here with transfer pricing. It's not always folks' top priority, so I think it's good to just kind of refresh on that. From there, we're going to talk about international provisions. And yes, I realize these are international provisions, not necessarily transfer pricing ones, but there's a reason for that, and we'll talk about that later. But we're going to cover off on some of the changes that we saw from tax reform. And then we're going to walk through a couple of examples. And really, we're going to do kind of then versus now type of examples. So pre-tax reform, which I think we're getting past 2 years. We may have to switch this up because the past is the past. But we just kind of want to talk about historically what we used to see versus kind of what we see now with transfer pricing and planning, both from an inbound and outbound perspective. So with that, I think I'll hand it over to Kylie to kind of refresh us all on transfer pricing.
Thank you. So this will be a little transfer pricing refresh, like Jason just said. So transfer pricing is the price at which tangible property, intangible property, services, and financing transactions are transferred between related entities of an organization across both international and state borders. So how I think of it is there's an entity in the US and an entity somewhere else, maybe in the US, maybe internationally, goods, services, and money is going back and forth. So they need to be priced accordingly. A fair share of operating profit must be allocated between related entities, and countries are concerned with taxable entities recognizing their fair share. Profit can't just be pushed to an entity located in a lower tax jurisdiction, for example. Instead, fairness is based upon the functions performed and risks assumed by the related parties. Profit flows to the entity with more and complex functions and the entity that's bearing more risks. This is why a functional analysis is very important. Through a functional interview questionnaire survey, we're able to assist a taxpayer with their transfer pricing by learning about the functions, assets, and risks of the related parties transacting and help determine the allocation of profit among those related parties. The functional analysis is also part of documentation requirements, which most countries have in place. There are two universal principles related to transfer pricing, which are called the arm's length standard and the best/most appropriate method. For US purposes, it's referred to as the best method, and for OECD purposes, it's referred to as the most appropriate method. The arm's length standard means that the results of intercompany transactions must be consistent with the results that would have been realized if unrelated third parties were engaged in these transactions. So essentially, what would two unrelated parties earn for a certain transaction? This is what two related parties should be earning. And in transfer pricing, we work in ranges. So a range of arm's length results would be determined through an analysis, and any point within that range would be considered arm's length. As I said just a second ago, the transfer pricing should compensate parties for functions performed, assets owned, and risks undertaken, which we learn about in the functional analysis. In order to determine the range of results that would be considered arm's length, it's necessary to use the best/appropriate method. This is the method that provides the most reliable indication of an arm's length result. And there are various methods, and there's no hierarchy of the methods, but it's important to note when you're documenting this why you chose a certain a certain method and why others were not chosen. And to speak just quickly about documentation, I have mentioned, most countries have documentation requirements in place. So this is a report that a tax authority may ask for that includes like company and industry overviews, the functional analysis, and an economic analysis. And in the economic analysis is where you would describe the selection of the best slash appropriate method, the arm's length range, the results of the entities, and noting if they are in that range and therefore considered arm's length. Why is transfer pricing important? So it's important to begin with because there are these documentation requirements in place. So that's one reason to have it. But because tax rates vary by country, which could create friction between multinational firms and tax authorities. So different firms like tax authorities versus the taxpayers have different wants or needs to have profit in different jurisdictions, and they're seeking different things. So for example, multinational firms seek to minimize effective tax rate while the tax authorities seek to maximize tax revenue. So the more profit in the US is more advantageous for the IRS because that means the IRS would be collecting more tax from that taxpayer. And the multinational firms also seek to repatriate tax efficiently, avoid double taxation, and avoid controversy. And on the flip side, tax authorities seek to prevent tax avoidance, prevent profit shifting, and enforce arm's length intercompany pricing. So to enforce the arm's length intercompany pricing, it's necessary for the taxpayer to properly plan for any intercompany transactions and then document that and make sure they are within the arm's length range. And avoiding double taxation is also a big one because if you aren't properly documented or you just haven't done the correct planning for intercompany transactions, that may cause double taxation and you may not be able to get that back in some scenarios. I'm going to go to the first polling question. Unless Jason, do you have anything to add on why transfer pricing is important? Slide.
Well, I mean, just I guess anecdotally, yes. Fairly recently, Kyle and I were both on a call with a client, and in very layman's terms, they summed this up nicely for me, at least I think, is they said, we actually really need to pay attention to our transfer pricing because tax authorities don't want you to, and this is their words, monkey around with your taxable profit. And that's absolutely right. And just to take a little bit of a step back, what we're concerned about here and what we're talking about is really operating profit or taxable profit, right? So not just from a manufacturer standpoint, not just really the cost after manufacturing, but really all costs and every expense baked in and what the profit is after that. So really what your taxable profit is before interest or EBIT. And really tax authorities are concerned that you are falsely trying to lower that taxable profit so they can't tax you in a nutshell. So, transfer pricing really is an important aspect, believe it or not, because, tax authorities are seeking to maximize the amount they're trying to tax you. And they can and often do make adjustments to taxpayers when are intercompany transactions. And that can result in some, double taxation, and it results in a whole host of headaches if you're trying to recoup any of that double tax if you've already paid it in a certain country. So transfer pricing matters. So that's all I have to chime in on, Kylie.
Okay, so the first polling question is why is transfer pricing important? Tax authorities are interested in maximizing taxes collected in their jurisdiction, potential for tax savings. Most countries have transfer pricing documentation requirements, or all of the above.
Nice. Yes, the intended answer was all the above. So I technically no answer is wrong, but yes, we were looking for all the above there. The transfer pricing documentation requirements have increased over the time I've been practicing transfer pricing. Most countries have some level of requirements. The U.S. Has contemporaneous documentation requirements, which means if you have intercompany transactions cross border, you are technically required to have a transfer pricing study in place when you file your federal tax return, or at least needs to be substantially complete, which allows a little bit of a gray area there. But you do need to do something in regard to transfer pricing by the time you file your federal tax return from the U.S. perspective.
Okay, so next I will speak about transfer pricing under U.S. tax reform. So the Tax Cuts and Jobs Act, which I will just refer to as tax reform going forward, was put into law and is one of the most significant pieces of tax legislation to date, which I'm sure everyone in this call has learned about and has dealt with in their everyday life. The purpose of tax reform is to replace the outdated tax system and prevent companies from shifting profits into tax havens. It has affected most multinational enterprises on an international scale. Generally speaking, the changes made by tax reform haven't altered the arm's length standard or the best method rule or documentation requirements or that kind of stuff, but there were some technical changes made related to transfer pricing that are of note. Tax reform has expanded the definition of intangible property, so it now includes goodwill, going concern value, and workforce in place. And I'm going to read a quote. Any other item, the value or potential value of which is not attributable to tangible property or the services of any individual. And it also gave the IRS the authority to require IP valuation on an aggregate basis or the use of realistic alternative principles. So some things that just affect transfer pricing and documenting some of the intercompany transactions. So along with that, there has been a major reduction in the US corporate tax rate from 35% to 21%. The US corporate tax rate was once one of the highest in the world at 35%, but now it's more towards the middle of major economies. So the taxpayer once had incentive to move functions and risks and therefore higher operating profit to entities located in lower tax jurisdictions. But now because we have a lower tax or corporate tax rate, those taxpayers might have incentive to consider a few following things. Moving functions and risks to the US, keeping existing functions and risks in the US, or expanding the functions and risks of US entities. For example, pre-tax reform, if a country had a lower tax rate than the US, this would give maybe a taxpayer the reason to keep profit in that country. But now that the US has a lower tax rate, those companies might want their profit to be in the US and taxed at a lower rate. But companies can't just move profit around. There needs to be business reason to do so. And out of tax reform, we also received the following things: GILTI, FDII, and BEAT, which are disincentives to locate IP functions in low tax jurisdictions, incentives to locate them in the US to serve foreign markets, and limits to deductible related party payments. Additionally, there is a lower rate applied to a broader base of assets, functions, and risks. So we will get into talking about those GILTI, FDII, and BEAT in a second, but one more polling question first. What changed to the transfer pricing regulations as a result of US tax reform? Companies can no longer rely on profit-based methods. Documentation is no longer contemporaneous. The definition of intangible property has been broadened, and the arm's length standard was removed.
Interestingly enough, Kylie, I saw some chatter come across today that the IRS or Treasury is looking to update the definition of intangible property further. So it looks like their goal is to, within this year, update the definition of intangible property. And so it could be an interesting year for transfer pricing, and we need to stay tuned as to what the IRS is coming out with.
Yep, so answer C is correct and might continue to be even more correct based on what Jason just said.
Yeah. Yes, definitely answer C there. So really the only thing that's changed with transfer pricing in regards to Tax Cuts and Jobs Act is the definition of intangible property was broadened, and it really it's going to come to light in a few minutes here when we talk about some of these international tax provisions that kind of came through, and I think why they needed to expand that definition here.
So I'm going to hand it off to Jason now for the next slides.
Okay, so the first topic or first major change that I guess relates to transfer pricing, but is not a transfer pricing change with regards to Tax Cuts and Jobs Act, is what we call GILTI, or Global Intangible Low Tax Income. And it's really a new type of what's called Subpart F income, which it has a long history within the US tax regulations and specifically international tax regulations. And the regime that it is trying to capture any income from a foreign controlled subsidiary that really shouldn't be income for that subsidiary. So in other words, it's kind of passive type income and really should be captured in the US at US rates. So, but GILTI can be applied to individuals and corporations. And there are some special rules and deductions for C corporations, and I guess we bolded and underlined the C corporations because that's important. So please pay attention to that, because you'll find out later. This next slide has a ton of words on it, and really ultimately, what GILTI is, it says, hey, listen, any leftover profit in a subsidiary after a calculation really flows back to the U.S. and is taxed at the global rate. So the new global rate, which we'll talk about in a minute, for C corps is 21%. For individuals, it's obviously higher than that, but it was reduced from previously in 2017 and in the past. So really, there's a calculation here that is a deemed tangible income return to capture what your GILTI tax is flowing back to the U.S. And what that DTIR is it says, hey, listen, 10% of your business assets gets backed out of that calculation, and then the rest, after you subtract some Part F income and a couple other, you allocate expenses, flows back to the U.S. and gets taxed at the U.S. rates. However, as we mentioned before, the C corp is allowed a 50% deduction on GILTI income. And again, that's through 2024. We won't talk about after that. But this deduction is actually quite a big deal, because it actually ends up at the end of the day really causing GILTI to not factor in that much unless you are in a really, really low tax jurisdiction. So in fact, south of 13.8% is really when GILTI is going to come into play. But again, that's for C corps. That does not count for individuals. So any LLCs, LLPs, S corps with foreign-owned subsidiaries, you are going to have to pay attention to this, and there may be some planning you're going to want to do. So the next topic is FDII, affectionately called FDII by many people in our world. It stands for Foreign Derived Intangible Income. And whereas GILTI was, I guess, historically or broadly thought of as a disincentive to, moving intangibles and having more income offshore, FDII or FDII was seen as the incentive for having more intangible type income and more exports coming out of the United States. So what it did was it created a new tax rate, so 13.8% for income that was derived by C corporations, and again, C corporations only, so that C corps comes into play again. And what they say is serving foreign markets. So if you're selling to a foreign market, exporting, and that product or that service is used in that foreign jurisdiction, so it doesn't make its way back to the US, you can get this reduced tax rate, and it's this huge incentive at 13.8% on income arising from those sales. But again, these are only C corps, so there may need to be some planning if you're an individual LLP, LLC, or S corp when it comes to taking advantage of any foreign derived intangible income. Similar to a patent box, which I put that in there because if you are familiar with transfer pricing planning, there are many countries, especially in the European area, that have things called patent box, where you can get a preferential tax rate for income that really is derived from using those intangibles, and it's usually certain types of intangibles. So it's a form of that from a U.S. perspective. The interesting thing, again, is this DTIR. So this is, again, this calculation, this 10% of your business assets, so your depreciable assets, gets backed out of this calculation. So this actually reduces your FDII benefit, which we're going to talk about in a minute here. And again, I think I'm repeating myself here quite a bit, but it's only available to C corps that aren't RICs or REITs here. So let's talk about GILTI and FDII here. So really what the lawmakers were trying to do here was create some disincentive to locating high value functions and risks offshore, and incentivize companies to maybe relocate or keep high value types functions to or inside the United States. But I want to point out, and this is really, this is really a kind of our opinion or things that we've talked about, and just want to point out is that this DTIR, so this 10% times your tangible, your depreciable business assets, really kind of reverses that, in my opinion. So in other words, if you have manufacturing assets which are likely to be depreciable, and you have those offshore, then that 10% calculation, which gets backed out of your GILTI calculation, is going to reduce that GILTI tax flowing back to the United States. So that profit that you would have to tax at US rates is going to be reduced even further. So that's an actual incentive, in my opinion, to increasing your depreciable type assets, in other words, manufacturing assets offshore. And then likewise, in the calculation of FDII or FDII, you're again backing out that 10% times your US depreciable assets. So that to me is a disincentive to increasing or keeping tangible depreciable assets here in the United States. So again, reducing your actual manufacturing assets and maybe pushing that offshore versus having your intangible type assets here in the United States actually is a disincentive to your FDII. So you'd want to maybe move that stuff offshore still, but increase management of those assets, keep that in the United States. And then once those products are exported out of the United States, you get that decreased tax rate using FDII. And so I've been alluding to this thus far, but talking about the definition of an intangibles, are we now saying that returns above a 10% calculation on your business assets is attributable to IP? I think that, and in my opinion, is a really blunt object of saying, hey, listen, here's what's attributable to depreciable assets or tangible assets. Everything else is IP. And again, they're expanding the definition of IP to include goodwill and going concern and other things. But that's really just a blunt object, in my opinion, on defining what intangibles are. And I think we're going to see that with just that announcement I mentioned earlier. I think the IRS is going to come out and really try to tie in what that looks like. And to me, I'll make the statement, maybe controversial, but I think that is actually ripe for even lawsuits or anything like that. I think if you were trying to make an argument that that's an inaccurate way of defining intangible property, I think it might actually hold up pretty well in a court of law. I haven't seen it come through with any court cases yet, but I could just imagine that happening. So, and just really, when it comes to transfer pricing, planning, or I should just rephrase that. Transfer pricing is planning when it comes to these international tax provisions. So first of all, going back to the functional analysis that Kylie talked about in the beginning is really key. So we really need to do interviews, figure out who's doing what and where, and maybe there's some inefficiencies in your supply chain or your value chain or where value is being created. And to the extent that it makes business sense, maybe try to think about where those types of functions should be, located, and maybe where the value should be created based upon, these changes in US tax law. So I'm kind of being a little coy here with these bullet points saying planning around or into GILTI, because there are scenarios that we've seen with clients where it actually makes sense to kind of plan into GILTI versus actually having certain income flowing back to the US. It may make sense to have it in a foreign jurisdiction. And then certainly planning into or around FDII. Ideally, we'd want to plan into FDII and try to get that lower tax rate, but there are times when it may not make a sense. This brings us to polling question number 3. So, what types of U.S. entities receive additional deductions after U.S. tax reform? And I repeated myself many times on this. So, partnerships, S corps, C corps, or sole proprietors. All right. Well, the answer we're looking for was C corp. So, again, if you're a sole proprietor, your partnership, or an S corp, there are not deductions available to you. Well, number one, let's talk about FDII. You can't get the benefit of FDII if you're not a C corp. But number two, when it comes to GILTI, you don't get that 50% deduction. So if you are a partnership, S corp, or a sole proprietor, you're going to want to pay attention to your foreign-owned subsidiaries and whether you're going to have a GILTI tax flowing back. And just so you know, there are ways to plan around that. And it may involve insertion of a C corp or using a C corp within your structure, which sounds scary, but it doesn't necessarily involve changing your structure to being a C corp or changing the type of entity you are to a C corp. So anyway, just a heads up that there is some planning available if you are not currently a C corp. So, all right. Corporate tax rate. Oh, I think Kylie, are you going to talk about the corporate rate cut?
Yeah, I talked about it a little towards the beginning, but if you remember, it used to be 35% and it's now 21%. So for the corporate tax rate. So if The US used to be one of the highest tax rates, and now it's back in the middle, which has led us to a bunch more like tax and transfer pricing planning for that reason.
And again, the individual rates are much higher than 21%. There are obviously deductions and, credits you get as an individual, but yes, that 21% rate has really, really changed, I think, a lot of tax planning. Now, we're going to talk about and give some examples here about, tax planning, again, from an outbound and then inbound perspective, and both from a pre-2018 and post-2018 perspective. But I just want to level set here when we're talking about these examples. We are not baking in GILTI and FDII, just for ease of presentation here. So just to be aware, we're purely talking kind of about planning around that U.S. tax cut rate. So to set the stage for this outbound planning, so if we have a company that owns and develops IP for non-U.S. markets, and their income, they're selling to foreign jurisdictions, and they have income concentrated in high tax jurisdictions. So historically in the United States, with the 35% rate, it was a higher tax jurisdiction. So to correct these inefficiencies historically, companies would set up a principal company structure in a foreign country that would take on those functions and risks that we keep harping on. A lot of times they do so in a cost-sharing arrangement that would share the IP with that entity globally. So outside the US, they'd have rights to use that IP. What you'd see is they're often, or I'd say always, located in a tax-efficient location. So in other words, historically, a location that had a tax rate that was lower than the United States. And it allowed for kind of regional operations to be centralized and kind of done. So those functions of risk would be centralized in kind of in a principal company outside the United States. So to put some visuals and numbers around that. So again, pre-US tax reform with a 35% rate, we had a US company, was the IP owner, did all the product development and research here in the United States, and they manufactured, where it doesn't really matter where they manufactured the product, and they sold it directly to customers in the United Kingdom. So historically, if they sold $100 worth of goods and they had $60 in COGS, they had $20 in SG&A, and they'd ended up with operating profit of 20. Again, we're taxing, we're looking at operating profit here. And the tax rate on those sales would have been 35% for a $7 tax expense. So clearly our rate is 35%. So that was just selling or exporting goods into the UK, all else equal. So then if we look at the company setting up an entity, so actually, sorry, I want to level set here. So if we look at, when we are working in transfer pricing, as Kylie mentioned earlier, we are working in ranges. So what does that mean? So often we look for company comparables if we're using a profit-based method, and we're looking at what their profitability is. And in this case, we're looking at publicly available companies and what their operating margins are. So just really simply, we're looking at this lower quartile in yellow here up to the upper quartile, and that is the arm's length range as we determined it. So want to point that out when we're talking about margins here coming up in this example. So that's why we stuck this slide in here. Going back to our example. So if the company in the US that is selling goods to the UK decides to set up a UK distribution company, they still have $100 worth of sales in the UK, but we say, hey, listen, what is this UK company really doing? Well, they're a distributor, they're limited risk, they're kind of being told what to do. And so we looked at companies and what those types of distribution companies earn, and they're typically earn at a median of 5%. So we say, hey, listen, on $100 of sales, their operating profit should only be 5, or it should be 5. And so that's your 5% operating margin on $100 of sales. And so then what we do is we end up backing into the transfer price with the US company of what it's sold for. So our SG&A kind of is what it is. It's $15 here. Then moving up and backing into, what we do is we can adjust the cost of goods sold to the UK to be 80 in order to reach, again, this $5 of operating profit that we say at an arm's length should be earning. So in flowing it back to the US, that's what our US sales would be 80. Now the cost of goods sold for manufacturer, again, is 60. It is what it is. And then our SG&A, we still probably have some SG&A or operating expenses related to those sales in the US. We have that. So we end up with, or we used to end up with $15 of operating profit in the US, taxed at 35%. We have our $5 of operating profit in the UK, taxed at 20%, which was the historical rate. It's lower than that now, which relieved us at a total tax expense of 6.3. So look at that. Our tax rate dropped to 31.33% historically again. So it dropped to obviously lower than what it was previously. So let's take it a step further. Historically, this is what we used to do. We'd say, hey, listen, let's move more functions and risk to that UK entity. We're going to say that UK entity licenses IP from the US now, so they're able to manufacture and sell the products. So the UK substantially contributes to the production of those goods, and they're going to sell to other related parties. And in this example, they're going to sell intercompany to France, to their French distribution company. So again, the total sales foreign sales haven't changed here. We're still saying $100 worth of sales. But really, just to point out what's happening here, is we have the UK licensing the IP, so they have a $15 royalty charge going to the US. The US still has R&D expense, so they back that out. And then our operating profit here in the United States is 7.5, 35% rate down to our tax expense of 2.6. Again, the UK is the entrepreneur in this scenario, and so it takes the place of the US in our previous scenario. So we switch over to France here. We say, hey, listen, that distributor, again, should only earn 5% on its $100 of sales. The SG&A is what it is, so then we back into the cost of goods sold from the UK. UK sales are 80 on those. The COGS are 50. Again, they have a $15 royalty expense, so they have $15 of operating profit at 20%. So they have $3 of tax. The French tax is 1.7. Look at that. We've dropped our rate down to 26.5%. So again, this is traditional pre-tax reform planning scenario. And I think this next slide just shows us kind of a comparison here. Look, we started out at 35%, dropped down to 31.3% just by having a UK entity, and then dropped it further by creating a kind of a principal type company in the UK. So then let's take that same example and say, hey, listen, after US tax reform, what's going on here? Well, this should look familiar. This is our first slide. And again, the tax rate dropped to 21% from a corporate perspective in the United States. So our tax expenses dropped, obviously, and the 21% is much lower than the 35%. So how does that affect us in terms of creating an entity in the UK? Well, same scenario here. We say the UK is a distributor, they should earn 5%, and everything else stays equal. But look at this, the tax rate, the differential is only 20.8% compared to our 21% in the United States. So the point being here, there are, which we're holding equal in our example, but there are business expenses to opening an entity in a foreign country, right? And hiring people and the time spent doing that. So there are actual business expenses that actually might make it not beneficial to actually setting up entities in foreign countries, and it may actually make more sense to just, I guess, export. So that has been a big change for us in regards to the reduction of the U.S. corporate tax rate. And this illustrates that what I just said is that there's less incentive to possibly locating those functions and risks outside the United States. So we're going to talk about an inbound tax planning example now. And again, we're going to go back to pre-tax tax reform in the US. And we're going to use an example of a Netherlands entity that owns and develops IP for products sold in the US market. So typically, before US tax reform, we would have inbound clients and we would say, hey, listen, the tax rate here is typically much higher than in your country. So what you want to do is maybe keep those functions and risks at the minimum level, creating limited risk type of entities in the United States, if at all possible, and try to set those margins in the US to be, on the lower side so that you're not paying more tax in the US. So again, let's go back to this table of operating margins. And as Kylie mentioned earlier, we work in ranges, and any point within this range is arm's length. So I just want to keep that in mind. So again, as we're talking about operating margins, these are the margins that we're kind of talking about in order to justify the margins that one of your entities would receive. So again, going to our example, if we have the Netherlands as the entrepreneur in this scenario, they're the IP owner, develop products, really kind of, well, they run the show here, and the US is really just distributing. So we used to say, hey, listen, what within that range that I just showed you is still arm's length? Well, 3% was within that range. So we're going to say an arm's length distributor in the United States earns 3% on that $100 of sale in the US. So again, going back into the price of the goods sold from the Netherlands, we say the SG&A, it is what it is. we get up to the cost of goods sold, and we say, hey, listen, that in order to make this $3 of operating profit, that arm's length profit, we need to charge $82 to the US. So that's the Netherlands profit is $82 here. Their cost to produce it is 60. Their SG&A is 5 here in this example, leaving operating profit of 17. At their tax rate of 25%, they have tax expense of 4.3. We would have 1.1 of tax expense in the US after our 35% rate. And then our total tax is 5.4 for a rate of 27%. But let's take a look at this same scenario after US tax reform. So we say, hey, listen, we're gonna leave these margins at 3% because that's what we determined is arm's length. But look at this, our rate here in the United States is 21%. So again, just by having this amount of profit in the US at a lower rate, the 21% in the US compared to the 25% in the Netherlands, drops our effective tax rate to 24.5%. Our total tax has dropped to 4.9. So again, just because the US tax rate, corporate rate has dropped to 21%, we're saving just taxes paid and our effective tax rate. But again, once again, let's return to our famous operating margins table here. And look what we say here down below. 6% is also within this range, which means it's also arm's length. Again, any point within these ranges is considered arm's length. So what if we said, hey, listen, the US, even though they haven't really changed their functions, they're really still just a distributor in the United States. We can justify increasing those margins to 6% without doing any changes. We haven't changed the business. We haven't made, contributed any more costs or changed anything, again, added functions or anything to the United States. So we say, hey, listen, the US should be earning 6% here. And we back into our calculation again, the cost of goods drops to 79. And again, because of this higher tax rate in the Netherlands, they have less taxable profit, which drops their tax expense. The US tax expense goes up a little bit more, but at a lower rate. And look at here, we have less taxes paid and we have 23.5% tax rate, just simply by changing the margins that the US company has earned, or should be earning at an arm's length. So this slide summarizes what we just talked about. So we just by increasing the margins, again, within the arm's length range, just increasing the margins reduce the overall effective tax rate on these sales. We could also possibly move more functions and risks into the United States, which would justify a potentially higher operating margin or higher margin in the United States at that lower rate. So it's really kind of the flip. Everything's have kind of flipped upside down from what we historically had planned on doing tax planning prior to 2018. So this brings us to polling question number 4. As a result of a lower U.S. corporate income tax rate, companies might change their transfer pricing to, first, increase profitability in the United States, move functions and risks into the United States, think twice before increasing profitability of foreign subsidiaries, or all of the above. Option, holy cow, 100%, all of the above, gold stars all the way around. That was the right answer. Yes. Awesome. All right. Well, so the last major topic we're going to talk about before we potentially get into some Q&A here. And, we've already mentioned GILTI. We already mentioned FDII. And I just have to say that we, in the international realm, we get the best kind of acronyms or abbreviations, whatever you want to call them, when it comes to U.S. tax reform. So we have GILTI and we have BEAT in addition to FDII. So BEAT, it's the base erosion alternative tax. And what it really is an alternative minimum tax. And I didn't make this real prominent, or we didn't make this real prominent in this presentation because it doesn't apply to typically the clients that we work with or the taxpayers that we work with. And the reason for that is it applies only to C Corps, number one, and it applies to C Corps that earn gross revenues of 500 million or more on average over 3 years, of the last 3 years. I've seen this argued, but it's our position that 500 million is US revenue only. So as we've seen with base erosion and profit shifting, there have been some thresholds around 750 million euros, 850 million US in terms of needing to be compliant with certain filings and reports. This is a US base. So if you have, it's not a global revenue, it's a US revenue. So we just honestly haven't encountered that many people, or sorry, companies and clients that encounter BEAT. But what it is it says, hey, listen, if you have intercompany payments going outbound and they exceed a certain amount of your taxable income, we're going to charge you, well, it was 5% for 2018. It's now 10% through 2025. So there's a 10% additional charge, alternative minimum, on those payments. So in other words, the goal of the lawmakers was to say, hey, listen, if you're shifting profits using intercompany transactions outbound, we don't want you to reduce this base that we're able to tax at a lower rate. We want to keep that base broad. So we lowered the tax rate here in the US, but we want that base to be broader. So we want a lower tax rate on a broader range of things. So in order to kind of increase that base or stop the base erosion, they have this alternative minimum tax that says we're going to tax you for these payments if it reaches a certain threshold. So the implication is it's typically what we've seen it, where I've seen it happen is on inbound or foreign-owned C corporations. So we have had a couple of clients that are foreign-owned, and they do have historically U.S. sales greater than 500 million, and they do need to pay attention to those outbound payments. Then we need to pay attention. Now, one thing that was favorable we saw come out since tax reform is they did clarify that on certain services payments, which a lot of companies get charged management service fees, cross borders. On those payments, it's really just the markup. It's not the base. So that was a kind of a huge ruling that we saw come out after this BEAT was implemented. But the other thing to pay attention to is acquisitions. So one of the examples we saw with a client was they didn't have really that many outbound transactions, and they were a C corp, they were over 500 million, but they didn't really have any outbound transactions until they were purchased by a South African company, and the South African company loaded them up with debt. And so this last box here says, hey, don't forget about intercompany interest on loans. Well, this South African company loaded them up with debt, and the interest payments were quite high, and it triggered BEAT. And so they had no idea that they would actually be triggering BEAT by doing this company buying this US company. And so these interest payments were so high that they actually did have to pay this alternative tax on these outbound payments. So again, if you are a US company, C Corp, greater than 500 million in gross receipts over the last 3 years, and you're making payments outbound, to a foreign entity, we need to look at these calculations and ensure that you're not actually triggering a payment here or requirement for BEAT. I think we have we have a bit of time left. Amy, do we have questions that we want to maybe pull up or see if we can answer?
We do have one question that came in, everyone. I'm just trying to capture it as it came in a little goofy, and I don't want to mess up the question.
Well, and so while you're doing that, Amy, I guess I'll just talk a little bit about, so we mentioned, I mentioned base erosion and profit shifting, and otherwise known as BEPS. So I think BEPS is the word or the phrase that folks have heard about quite a bit since 2015. What we didn't cover today, back in our transfer pricing refresh, was what's happening from a BEPS perspective, which is, so the BEPS is an OECD initiative that came out, was pushed out in 2015, that gave a series of action items that they're encouraging countries to follow in order to kind of level the playing field when it comes to countries being able to tax, tax companies in a rightful way. So in other words, trying to get their fair share of the taxable income. Because I think as many smaller countries or countries that are developing have felt over the years, is that companies that are headquartered in more developed companies are taking advantage of developing countries when it comes to lower taxation and shifting profits and shifting functions and risks to other countries. So just keep in mind that that is actually a fluid environment, and more specifically around the digital economy. So the OECD has come out with some solutions, as countries independently have tried to come up with their own solutions for taxing these large digital type companies. Now, yes, we're talking about kind of the Googles and the Facebooks, but there is thresholds that are proposed, I think, again, around the 750 million euro in revenue number. And if your company is getting towards that number and you operate in digital platforms, it's not just the digital giants that they're going after. So if you operate, which most companies do, in a digital fashion, there's some interesting things coming out on a country by country basis that the OECD is trying to stem off. And interestingly enough, the proposals that are coming out are really not arm's length standard based. So I know it's pretty vague and that's pretty complex, but there's some things, and we're writing an article now to try to cover this, but there's some things we need to be aware of about dealing with the digital world and digital taxation. And I think countries have backed off a little bit, maybe to see what the OECD is coming out with by the end of 2020. But beyond 2020, I think it's up in the air as to what's going to happen with a lot of the digital world. So
Maybe one thing that looks like it's noted is we talked about court decisions maybe being overturned, or just the court system in general we talked about.
yeah, I mean, I'll say this again. That's purely my opinion. I just think that applying a broad definition of, hey, 10% above your qualified business assets is the new definition of intangible. I just think that that's ripe for challenge. I'll put it that way. There's been 0 court cases. Nothing's been overturned. It just seems, again, to be such a real blunt object, as I've said before, in trying to determine what intangible property is. I mean, if we're saying that that's what intangible property is, then I think that's a big statement, and I don't think it's an entirely accurate one. And it really does reflect poorly upon a lot of tax planning that's been done by a lot of major U.S. corporations in terms of, hey, listen, let's really look at what our intangibles are and where the value lies and who's developing that value and who owns it and who's exploiting it economically. So if we're now just saying, hey, 10% above your business assets is intangibles, I just think that that's really just ripe again for challenge. And I just don't see it being, honestly, it's just hard to accept, and it's for me to accept, and it just doesn't seem that viable, because I think, especially if you consider types of businesses that are not asset intensive, right? So if we have more digital type companies, and maybe they even outsource a lot of their manufacturing, so they just really have very limited business assets. So that just seems to be, again, I just don't think that's an accurate definition of intangibles. And I think that a lot of companies might end up challenging that. Does that kind of answer? You think answers the question, Kylie?
Yeah, I do. We talked a lot about the functional analysis with respect to intangible property, and I think that just becomes more and more important as they're broadening the definition of intangibles, because it's very easy, I'd say, for a tax authority to go in and just ask and question what intangibles are located where. So as long as you, A, know that, and B, document where they are, there's less things for them to question if it's like clearly laid out. So just,
Yeah.
I mean, having a good understanding of where everything is and what's there.
I agree. I've said this cliche a few times before, but I think, everything old is new again. We go back to the functional analysis. That is bread and butter transfer pricing law in any country. I mean, that's been around forever, is going back and looking at who's doing what and where. And it's just, again, it's so important. It's one of the most basic things when it comes to transfer pricing, but it is probably the most important thing that you can do, is figuring out and laying out for tax authorities, the functions and risks of your entities and what they're doing and who's adding value and how they're adding value and why that value is what it is and should be compensated, rightfully so.
A question we ask a lot of times with functional analysis is, like, if you weren't getting this service or this good from your related party, like, would you be getting it from a third party? So that's always a good thing to think about when doing the functional analysis.
Yeah. And what would you be paying them?
Yeah.
Yeah, I agree. All right. Amy, does it look like there's any other questions?
Nope, that's it. So.
Okay. Kylie, anything else to add?
No, I think that's good. If anyone has questions, like after, our emails are up on the screen.
All right, Amy, I think that's it for today.
Awesome. Well, thank you all so much for attending, and thank you to our presenters, and I hope everyone has a great rest of their Friday.